Okay, everybody, welcome back to This Week in Startups. I'm your host, Jason Calacanis, and this is our special Startup Basics series. What is Startup Basics? The series started a couple of years ago to go over all the blocking and tackling, the basic heuristic fundamentals of doing things right in your startup. From a legal perspective, from an accounting perspective, and finance and HR, all this stuff is, let's be honest, it can be super boring, but it can also be super important. And frequently, we see companies that have to spend a lot of money cleaning up problems. And so it's in our best interest that everybody get things right from the beginning. And so one of those things you want to get right is accounting and finance. With me again, Scott Oren, my friend from Kruze Consulting. Welcome back to the program, Scott.
Hey, Jason. Thanks for having me.
All right. So if anybody wants to see the previous ones we've done with Wilson Sonsini, et cetera, Salesforce, you can go to thisweekinstartups.com/basics. thisweekinstartups.com/basics. And if you want to get in touch with Scott, go to kruzeconsulting.com/twist. All right, Scott. On this episode, I want to talk about the year end, wrapping up your year. Always chaotic for startups. Probably have to do not just financing stuff, but they might have HR stuff they have to get done by the end of the year, like reviews and bonuses. Maybe they've got a board meeting they've got to get to. They probably have year-end targets and quarterly, fourth quarter targets they need to hit. And then everybody's on vacation. Nobody's there to fund their companies. It's just chaos. So let's talk about one of those, 3 or 4 storms that typically hits a startup or any company, which is wrapping up the year. What do you have to do to be prepared for Q4 and wrapping up the year, getting your taxes done, closing your books, et cetera?
Yeah, you nailed it. There's so much going on. So maybe we can break it up into taxes and then just kind of like the financial world. So for taxes, it's actually kind of an exciting, normally it's like, it's not the most fun thing to do. But with COVID, there still are a lot of like government grant or tax credit programs that people can take advantage of. So it's almost like you get paid to actually do your taxes and take care of your taxes the correct way this year.
There's actually an incentive to take this on because, let's face it, a lot of companies, startups included, were beneficiaries of PPP loans. There were other loans for retail people. I mean, we pumped a lot of stimulus into the system in 2020, and it continued into 2021, which I think some people don't know. So let's break down some of those goodies, some of those COVID goodies that got sent. These are not stimmy checks to individuals. This is actually for companies.
Yeah. And the government knew that starting, post-COVID, it was going to be a really hard time to start a business, but they also really needed employment, right? Remember how many people lost their jobs in 2020? It
was shocking.
Yeah, it was crazy, right? And Great Depression kind of stuff. And so it started with the Trump administration and the Biden administration carried it on. But there's a category called employee retention tax credits, ERCs to be short. And the simplest one to explain is it's going to be super important for your companies, to launch investment companies. Anyone started after February 15th, 2020 is actually eligible for up to $50,000 in employee retention tax credits in Q3 21 and Q4 21. So again, and it's maxed at $50K per quarter. But if you've got 10 well-paid engineers on your team, you're going to max that out pretty easily. So what you have to do is file an amended payroll tax return with the government. It's called a 941. Some of the payroll companies are helping with this. CPAs like ourselves are helping with this. You do want to have the backup on this to prove you're eligible, because I do think there'll be some audits on this. We talked about all the money getting pumped into the economy. Well, the IRS is looking at that saying wow, that's great, but we really need to make sure people play by the rules.
Right.
Let's do this right. So that's the first one. And again, it's for newly formed companies were formed after February 15, 2020. That's
so if your formation date is basically 18 months or less, this is something you don't want to, if you're under 2 years old, but make sure that formation date is after February 1st, 2020, when the pandemic hit.
Yep.
And the concept here.
February 15th is the key
February 15th.
date.
Got it. Okay.
And we've had companies that were incorporated on February 13th. That didn't make it, which is a huge bummer, but that's the magical.
There's $100,000 potentially sitting out there. So if you got 10 employees, you're post February 15th. So a seed funded company coming out of an accelerator will count for this if you've been incorporated for 3 or 4 years. No, but if you've been incorporated after February 15th, that's great.
Yep.
And the goal of this is for you to be incentivized to, hire that 10th person, let's say 11th person. So this is not like in Canada where people will get like an entire engineer for free or, these huge credits, but it's a little something. It's a pot sweetener. It's certainly something you want to check out. Now, the other thing I wanted to know about was the R&D tax credits, because I keep hearing about this. I think there are even some startups that are specializing in trying to get people these. I get pitched on them a couple of times. Obviously in Canada, Australia, Ireland, a number of countries historically that are trying to promote their tech businesses and invest in it will give a full tax credit for R&D. In other words, an engineer or a scientist is working on something forward-looking, not maintaining your current version, but working on your 2.0. You fill out a form at the end of the year, typically in those countries. But we have this in the United States as well.
We do. And it's been around. Like Vanessa Kruze, my wonderful wife and the founder of Kruze Consulting, is one of the first people to figure this out, probably like 4 years ago. And what had happened is the IRS and the Treasury got together. Before R&D tax credits, you could only apply it on profits. And so like startups are not going to be profitable for a long time. That's just the way it is. So it wasn't super applicable. And then, Vanessa figured this out through the regulation change that the IRS and Treasury said, hey, you know what? We're going to let you take the R&D tax credit against your payroll taxes. And pretty much every startup pays payroll taxes because by definition, you're building software and you're hiring engineers. And so it became this like immediate ROI for all the startups.
So it's not just based on profit. If you're a startup, you're obviously investing for the first 5 to 10 years. If you're venture backed, they're not looking for dividends. They want you to build the business and work on the top line growth. But here you're saying, hey, the change here is you're getting this tax credit of up to $250,000 a year. Doesn't matter if they're an employee or they're a contractor. It just matters you paid taxes.
It matters. If it's US based employees that are like engineers, scientists. It is rooted in the hard sciences. There's a 4-part criteria to be eligible. And by the way, if I may, it's super important that companies follow the rules on this. We are seeing audits, like we're involved in audits right now. This is happening. We had a company acquired by a Fortune 500 company that's going through the audit right now. Like this happens. So please do it correctly. I'm slightly biased, but I'd say work with CPA firm. It's great that there are startups doing this, but like CPA firms have a way higher level of diligence and regulation.
Skin in the game.
Yes, exactly.
Well, you're putting your name on it. Therefore, if there was something fugazi, there is some blowback for an accounting firm, right?
Oh, huge. And we're signing the tax return. This is a component of the tax return. It's like visualize like stapling a giant section to your tax return and sending it in, right? Like it's not like a standalone document. It is part of your tax return. So it's US based employees that are engineers, scientists, hard sciences, and then US based contractors also apply as long as they're scientists, researchers. The people, sometimes people get a little confused. If it's someone who's a contractor in another country, that doesn't count because they're not paying Social Security taxes in the first place.
Got it.
So the government doesn't really want to like rebate Social Security taxes that weren't paid in the first place.
Yeah, the goal here in our government is to have employment here in the United States and taxes paid here in the United States. So if they're going to create an incentive like this or the other incentives that were created during COVID, it follows that the incentive is designed to grow America's economy, not other economies, right? So
absolutely.
Fair enough.
And they want everyone to hire as many engineers as possible because that's what creates all these amazing companies that then hire thousands and thousands of people. So
correct.
Yeah, yes. I think this tax policy is actually really smart on the R&D stuff because it's incentivizing companies the correct way.
And let's be honest, this isn't some crazy $10 million grift. This is $250K. It's capped at, right?
It's capped at 250, but you can actually, in the fine print, you can actually go above 250, but everything above 250 is applied to the profits, kind of like the old school way.
Got it.
So the startups are most of them are maxing out that or not maxing out. They're hitting that 250, the super well-funded ones, but not really going that far beyond it.
Makes sense.
Yeah. So.
All right. So then what are the best practices for just making sure you get your taxes done on time? Like what should you be doing on an infrastructure basis to make sure that the end of the year in taxes gets done easily, gracefully, and you're not like chasing your tail or have, investors or board members upset at you?
Yep. Well, maybe the simplest thing is to actually line up your tax preparer or CPA now. We always joke kind of internally at Kruze that like January 2nd comes and we get like 10x the emails of people want because everyone set their calendar reminder for January 2nd to line up their tax preparer. If you can do it in November and December, this is the slow time for a lot of accountants. And so great to line it up now. And then you're going to want to kind of like, there's a lot of checklists on the internet. Like we have our own checklist for each startup metro. So if you're in Boston or Austin or New York or San Francisco, you can get your own checklist. And the big things you're going to want to cover or prepare for are 1099s, which go out to all your contractors and firms like partnerships, like law firms or landlords are often partnerships because it's like held under REIT type of structure. You will send them 1099s. You have to do that. I forget the fine, but I think it's like $2,000 per 1099 not sent out. And those do get audited. The next one you're going to want to do is your Delaware franchise tax, which is typically due March 1st. Again, that's your corporate shield, like your liability shield.
Yeah, don't want that to expire. Yes, there's a reason why everybody is like filing in Delaware. It's not because of the incredible vistas in Delaware. It's because of the very pro shareholder framework that they've developed over years.
Yeah, and that website is not the greatest website of all time. You'd think they would. So sometimes this is a little meta tip here, but people punch in their numbers and they're kind of like in a hurry to pay it. And they'll email us and say like, it says I owe $40,000 or $80,000. Just be patient. Let the website think, calculate. You'll probably owe like $400, not $40,000, but I might have saved like 3 people a heart attack just by explaining that.
Yeah.
So that's one. And then the second big one or third big one is the states. So California is April 15th. New York, I'm forgetting the date, but I think it might be March 15th or March 30th. Massachusetts is March 15th or March 30th. Check the calendars. But each state that you're operating in and that you've registered to do business in, you typically have to pay like a franchise tax or an annual tax. California's the largest at $800. I think New York's $350. Just make sure you pay that. If you don't pay that, they're in the bowels of the IRS and the state governments. Those numbers and accounts and your social security number are all there. And like 8 months later, you'll get a debit on your bank account and end up paying way more than if you just would have taken care of it.
Just do it right. Yeah.
Do it right.
Now, what about PPP? Because this, a lot of companies, that we invested in reported back like, hey, we had our best month ever. And it was like this spike. And we're like, what is that? A lot of customers like, no, we got a PPP loan, whatever. And it's like, okay, is it a loan or is it a gift from the government? Yep. This idea was always that there would be forgiveness for these if certain things happened. And I think that's happening now, correct?
Most companies now have been really good about getting their PPP forgiven. If you remember, there was the initial PPP and then there was something called PPP2, which for companies that were like really hard hit, like you mentioned the restaurants earlier.
Retail.
Retail, or companies that like had to basically like shut down. So most companies have done forgiveness. For those that haven't, it's a good time to do both 1 and 2 now. Make sure you're using... This
is independent of taxes. You can do this at any time.
Exactly. That's a great point. And you kind of want to clean it up. If you can, like now would be a great time at the end of the year. So it's reflected on your 2021 financials. There's no weird hangover. Like the way you're talking about it, right? You've had to ask that diligence question of like, what's this $250,000 or $500,000 balance on the balance sheet, right? So clean it up. The good news is that is not taxable income at a federal level. Some of the states it is taxable. So like California is taxable. But so federal, like it's just going to be on your other income line down way at the bottom of your profit and loss statement. Do not book this as revenue. That's like cash accounting. Cash accounting, doing incorrectly, someone would book it as revenue. And that's the kind of thing that you find out a month from now, when you're pregnant. You don't want to do that. So just book it as other income. It's a forgiveness. It goes to the equity section of your balance sheet. Very easy. And you're just going to do that in your lender's online portal. They all have their own portal. You go in there. There's only like 2 or 3 questions really for the early stage companies. Your payroll provider can typically do a very quick export of a report that's PPP centric that will give you all the answers. And then it's just important to, sign or agree to the reps and warranties like you should, and you're good. You actually find out like 2 weeks later. It's actually a very fast process. But now's the time to do it. Like it's like a little bit of like winter cleaning. Just sweep out, get the stuff done.
And of course, you should have been doing your P&Ls all along, every month. You should have been correctly reconciling your bank statements to your P&Ls, to your accounting. You should have been making sure the credit cards and all the expenses were properly, what's the term when you assign them to a category?
Categorization. That's
okay, categorized properly.
Yeah.
There's some other word for when you put things into buckets on your P&L. I forgot what they call that process. Where you're like, okay, we're going to have these buckets for revenue, these buckets for expenses.
Your chart of accounts. And the chart of accounts is your friend because that helps you quickly, and your investors. When they send you the profit and loss statement, you can eyeball it quickly and see where they're spending their money. And, oh, God, I understand. Yeah.
Oh, yeah, this is marketing spend. Oh, my God, look, this is a company that's a subscription-based consumer company, Calm.com, Steezy, Fitbot. Oh, yeah, they spend a lot of money on Facebook ads. Okay, that's their, okay, but, oh, yeah, where's the salaries? Okay. This is a SaaS company. We got a lot of salaries in the sales and marketing team. Yep. Oh, this is a direct-to-consumer product. We don't have a sales team. Yeah. Just for people who are shifting from one board meeting to another as a accountant, lawyer, or investor, board member, that's how you kind of get your bearings on the business, right?
Totally. And I think you're making a really great point in that people like you have a shorthand in their head, and it allows you to look at the stuff very quickly and know if the company's performing, know if it's not performing, and know if there's anything fishy. Like you see a biotech company spending a lot of money on Google ads, and you're like, something's wrong here. Like that doesn't, there's something wrong.
Or consulting, sometimes there's a consultant line. You're like, what's that about? Who is this $100,000 a month consulting for 4 months? And it's like, oh, we hired a PR firm. And it's like, what?
Yeah.
What do we get out of that? All of a sudden these things stand out, and you're like, huh? Or the travel and expense line, and you're like, I've had companies that have this extraordinary 10%, 20% spend on T&E. And I'm like, wow, travel and entertainment in a startup? Like, where exactly are we going?
Yeah. What's going on there?
Yeah.
And also, like we talked in a previous episode about customer acquisition costs and lifetime value of the customer. I think people like you are probably doing a quick calculation in your head of sales divided by marketing or advertising. Okay, totally. That looks like it's working, So you talked about Calm, that's probably something you do at the Calm board meeting.
I'm not on the board of Calm. I wish I was. But I mean, I own a lot, which is even better. But would have been nice to be on that board. That was, interestingly, in the early days, we didn't ask for board seats. When we got to 5% ownership, we said, hey, you probably should have us as an observer or a board member, just so you have us as help. And it's been great for me. It's super educational because I am up on a lot of these issues because the times that this comes to me is some weekend phone call, can I talk on the phone? And I'm like, oh God, here we go. You can't put this in Slack or SMS. Okay. Yeah. It's going to be one of 3 or 4 short things. None of them are good. Only one of them's good. We're getting bought.
But the fact that they can call you, the fact that they can call you is amazing. And that might be a 20-minute conversation with you. Yeah. Whereas it's a 3-hour conversation with a lawyer because you've seen so much, your shorthand is
Well, generally speaking, these things are very scary when you go through them for the first time as a founder. Yeah. You probably have had this experience where you tell a founder okay, this is something we got to fix. It's going to cost $20,000 to clean all this up. It's going to take 4 months. And all of a sudden they start sweating. They're in a panic. And it's this is painful in the same way going to the doctor and having to get a shot, or going to the doctor and having to have a growth removed, or maybe even worse, you got a benign tumor or something like that. There's a scale of how bad things can be, but generally speaking, it's better to address them than not address them. I think that's the big part that you'll get out of the Startup Basic series. Okay. One thing I think is super important is employee bonuses. If you're doing them, most startups are not doing bonuses, but when you get to Series A, Series B, maybe Series B, there might be comp packages that include a bonus, typically 10, 20, 30% of the salary in my experience, for hitting very aggressive targets. Is that generally correct? You don't see them in C and A, but you might see them in B and C when you start having 10, 20 million in revenue, and you want to incentivize the management team to hit 3x, 4x, 5x growth. And for the investors, giving people a 30% bonus for, doing an incremental 20% is great for everybody because the valuation goes up significantly.
It is. And there's one little kind of small point here, which is sometimes founders are really nervous. One of these calls you might get is gosh, my sales team is making so much money in bonuses this year.
Good.
And exactly. That's the point I want to make. That is actually some of the best money you can spend because it means they're killing the plan. It means the next fundraise is going to be so much easier.
And at a higher valuation.
Exactly. So it's okay. I've answered questions before, oftentimes the VP of sales is the highest paid person in a startup.
Almost universally, yeah.
Yeah. So that's okay.
It's something that I think a young founder has to get, or not even age-wise young, but a first-time founder has to get used to. I remember when I was running my first magazine and I just told all the salespeople, hey, get 10%. They were getting paid $50K, bases, had 5 salespeople, 1 salesperson, all of a sudden sells $1 million. Now, this is in the 90s. So now he's at $150K. I was paying myself a $5K a month, $6K a month draw, basically $60, $70K a year to live in Manhattan at that time. Was okay salary. Wasn't terrible. And this person's making twice as much. I mean, I see the payroll going on and I'm like, this guy's like got a BMW and is going to the Hamptons and I'm working. And he had a share in the Hamptons. I was about to get resentful. And then I was like, I own the company, and I own 95% of the company. So.
Yep. And that person's making your life so much easier. So yeah, I totally agree.
Yeah. I mean, you want them to crush it. Now, that doesn't mean in the next year, you don't reset and say, hey, here's the new plan. You're going to get 4%, instead of 10%, you're going to get 8% on the first million, 9% on the next 500K, 10% on the next 500K, and 12% after 2 million. And we set higher targets. You are well within your right to do that. Totally
great. One other little thing that companies can do to make those bonuses a little more palpable is incentivize the sales team to get paid up front. Because then you're really just taking the cash you're getting from the customers. You're almost like not dipping into your equity to pay those extra bonuses too. And it helps extend your runway. So that's a great one.
Point. And then, in terms of cash flow, another thing I've seen and I've always done is commissions get paid when cash comes in.
Yes.
Not when you sign. So I've seen founders start paying people for signed contracts and then they cancel. And then what do you have to do? You have to pull the money out of the person's account. And then in order to get paid your commissions, you have to be here when the product is delivered and we get paid.
Yes.
So those 2 criteria. If somebody leaves and they've sold 500K looking forward, they don't get the commissions on that because they're not here when that money comes in. They may have sold it, but they didn't deliver it. And so there is a reasonable strategy there, correct?
I totally agree. Both those points are fantastic. And experienced salespeople generally know that. Mm-hmm. So don't let them kind of fast talk you around or try to push you around. Like, those are 2 things you can really kind of hold to.
And in a startup, there's no such thing as severance, maybe Series C or something like that when it's a robust, but you don't see people in packages giving people robust severance packages. And it's a bit of a red flag in an early stage startup when people ask for that kind of stuff, correct?
I do think that there's a place for severance in the sense that you kind of think about it, it's a little bit transactional from the company's perspective. You only want to give severance if people are going to sign a release. If they sign the release, and that's something we do at Kruze, we want to help people, but we also want people to sign that release because you never know if someone's going to wake up 6 months from now and have a bad taste
or say something bad about you, write a blog post, yada, yada.
Yeah. So
I'm just saying in the comp packages, like I've heard people who are leaving like Disney or something like that. And then I'm on the board of a company like, they want a 2-year severance. I was like, what?
Yeah,
we have 18 months of runway. Nobody's getting a 2-year severance. Like literally. They started a 2-year severance. I'm like, they can have 2-week severance. Or if you leave the job, you get 0. Like, and if we fire you, you get 0. Like, what? And then like, now we have to do a whole paragraph on what is cause. And it's like.
And that's also a red flag during the interview process for you that like maybe the person's coming from a Fortune 500 company. And it's notorious that transition from a Fortune 500 company to a startup is very difficult. And that's kind of like your first red flag, like someone asking for 2 years or a year or whatever.
Crazy.
That just should tell you, like, you need to
not hesitate. A startup employee, period.
Exactly.
Startup employee is thinking, if you don't want me, I got 10 other people who want me. I'll take 6 months off. I got cash in the bank. I got 3 months off. I'll be a consultant. I'll be an entrepreneur in residence. I'll sell NFTs. Whatever.
Totally. And one other thing, since we started talking about severance, employee liability insurance is actually a thing that I recommend to companies nowadays.
Explain what it is.
Yeah. So that's basically that use case where that you let someone go for cause or something happens or someone's harassed or whatever it is, employee liability insurance will actually protect you. You will pay a deductible, it's usually 5 or 10K, but that insurance policy will actually pay for the litigation.
It's amazing, yeah.
Penalties, things like that. So that's something
I do recommend. This didn't exist in the early days.
No, it's relatively new. Yeah.
And I think the reason is you have so many drive-by lawyers now who they know a startup has raised X amount of money.
Yeah.
You got 10 million in the bank. They're like, they're a target. And literally people leave and they just know if they shake you down, the cost of fighting it's $50K.
Yep.
And the cost of paying it off might be $15K, and everybody moves on with their life. I fight everything to the death, period. Like, only once have I ever acquiesced, and it was for such a tiny amount of money I did. But it was like for unnecessary. This is literally a true story. When I was running Mahalo, somebody worked for us as a freelancer in California, and then they claimed that they were working like 10 hours a week. And maybe they did 1 month, like 80 hours. They claimed they did 18 hours in a row, and that we didn't pay them overtime.
Yeah.
And we're like, you're a freelancer. You signed a 1099 contract. We didn't direct your work. We have this all perfectly lined up with all the tests and everything. And literally, the person at the hearing said, "Listen, you raised $20 million for the company. Just pay it. It's only $4,000 or whatever." And I was like, "But it's not true. We paid her the $2,000. We don't need to pay another $2,000 in overtime. She was a 1099. She signed it. I have 100 other 1099 people. I'm going to have to cancel the 1099 and move it offshore." Like, literally, this is my argument to I guess it was a mediator type thing in California they do before you kind of go into all this.
Yeah.
My attorneys are like, "You're in $8,000 for this already. Just pay it."
Yeah.
You might win. I was like, "How much does it cost to win?" It's $15,000. So now I'm like, oh my God, this is like sunk cost. For people who want information on that, we have a partner in broker.com/twist. So I will mention one partner. Since
we work with Embroker a lot too. They're really
they're
great.
really good at startup stuff.
That's actually where we get our insurance, through Embroker.
Me too.
So if I can make one point on that, the legal aspect too, Jason, like, you've done the Wilson Sonsini series, like that. Every big law firm in Silicon Valley will give you a package, including contractor agreements, including the template to spec out what you're doing with that contract. That is your best friend. Fill that out every time. Be religious about that. It will protect you.
And by the way, and understand, you doesn't mean that people can't sue you. They still can. There's bogus claims filed all the time. So even if you do everything right, and then you have to understand, what is the worst case scenario in all this? It's not going to be the risk of ruin for your company. It's going to be a speeding ticket, and maybe you weren't actually speeding and you had to pay the speeding ticket. Like, that's literally what happened to me. I was driving 55. They claim I was driving 70. And I'm like, how long am I going to fight the speeding ticket? It's, it's $25, in the grand scheme of things, I'll just pay it. So anything to do with the cap table at the end of the year?
Yes.
And when you're doing this reconciling, because I've never heard of reconciling your cap table in a year, but you brought it up, I think, in our notes here.
This is one of those like accounting things that all the good accounting firms do that no one really knows, which is you take the cap table, oftentimes people use Carta or they use like an Excel spreadsheet or whatever they're using, and match the actual
captable.io.
Yes, that's another good one. You match the cash flow or the cash that came in from investors. And a couple times a year, this is not going to surprise you, but we'll find like $50,000, $250,000, some meaningful amounts of money
that wasn't on the cap table. In other words, you're doing the lawyer's job, back testing the cap table against the incoming investments.
Well, also the main, because we're accountants, so we're looking at the cash, and like there'll often be a wire that bounced somehow, and no one
missing
knew.
Wire.
And the VC firm thought they funded it, or the angel thought they funded it.
Yes.
The company, not as organized as they probably should have been, and didn't reconcile the cap table. And so we get in there, and also, that's it's like a fun but also scary moment for the founder, because they have to kind of go back to the investors and be
it's a big mistake. This literally happened to me in Vegas. I was at the Aria. I had wired money. They confirmed they wired it back. I saw the wire had happened, but for some reason the wire got reversed. I'm now in Vegas at the Aria. 2 full years later, I go to the cage. I'm like, "Hey, listen, I need a marker." She's like, "Do you want your front cash?" I'm like, "What are you talking about?" She said, "You got $36K in front money here." I'm like, "I have $36K here?" She's like, "Yeah." I was like, "What's the date on that?" She said, "What's the date?" I said, "You guys wired that back." I said, "Nope, it's still here." I look in the back. It had gotten reversed. I didn't know it. It had 36 dimes. I was like, "Give me that money. I'm going to the poker room now. Let's go." But it happens. Things get reversed.
Customer,
yes, exactly. I would have had it there forever. Well, so it eventually would have come up on these claim sites. I'm getting a bunch of emails from these claim sites now of like, for some reason, I had a Wells Fargo account for Mahalo back in the day. The account got shut down. There's $16K from like an AdSense payment or something in limbo. And all these third parties keep contacting me because I guess you have to publish it when you're Wells Fargo, bad accounts or whatever. Like when there's free money out there and they're like, "You have some money here." And I had like a Barney's gift certificate for $500 I found. And I was like, Barney's out of business. Like,
The big question is, did you win at the poker table at the REI, or what happened to that 36K?
Yeah, that's a different story. All right, let's see. Obviously, you're going to do your financial model and basically check in on that as you get to your end of the year. Probably going to be planning it for next year. Is that good to do with your accountants or share with your accountants and do waterfalls and stuff like that of when you're going to be cash out? When does a founder go from making a model themselves in a spreadsheet to then getting their accountants involved with it, if at all?
Yeah, most accounting firms will have like an FP&A team or person. So we have like a team that will
financial planning.
Exactly. Yes. Thank you for explaining that. So that's kind of like part of the package typically. We have a free, very simple, but it's kind of all you need as a very early stage model on our website. You can just download it. I think Google like financial model, Kruze Consulting. And that's designed to be very simple because sometimes people get intimidated. They're like, I'm not a Goldman Sachs analyst. Like, how am I going to do this? You really just need a forward-looking version of your profit and loss statement. Obviously, when you hit like Series A or Series B, you're going to have the income statement, balance sheet, and cash flow statement because the board is going to want something more complex. But even just doing that little exercise will do two things. It'll tell you your cash out date. It will also help you see all the moving parts of your business and where you're spending money, how it's coming back to you. So it's a really good exercise. So we really recommend that. And then getting the board to approve it in December or January, I think is a really good best practice.
Sure.
Because it facilitates this whole conversation. Like you've probably been there many times where you're like, hey, I'm not sure this is aggressive enough, or maybe you guys can do better. Or, hey, tone this down a little bit. If you don't hit your revenue numbers, you're going to run out of cash really quickly.
I mean, that is the key, is understanding what cash is required to hit those targets. And you might have investors who, they're very successful. Your company's, doubling revenue every year, but they got companies in their portfolio that are tripling, quadrupling, doing 5x revenue, and they've got these huge winners, and they would rather you take more risk. And then you have to have this very delicate conversation about, well, that's a really aggressive target. I think we have the risk of ruin here. We could burn through all of our money in 12 months. I'd rather, cut my burn 50% and have 24 months of revenue. And that's really what a board is about, is to have like a Socratic kind of debate, maybe is like the word, or, an honest, candid debate about what everybody's goals are and how much risk we want to take. And then you want to check in on that plan. And hope is not a plan, as Doug Leone at Sequoia told me one time. He's like, what's your plan? And I was like, well, and he just knew I didn't have a plan. And he's like, Jason, hope is not a plan. Because I said at some point, well, we hope to hit. And he's like, hope's not a plan. Yep. Plan's a plan. Yep. Make a plan.
Yep.
And so making a plan, it's good. It's like writing, because when you write, you have clarity of thought. When you make a plan, you have clarity of thought.
Very well said. The other kind of Socratic question you can ask them is, if you were outside VC, would you fund my company? And that's a little bit, you're putting them on the spot a little bit, but you're going to get like the real scoop there because, like you said, they've got a lot of companies. Maybe they're not going to give you kind of the full feedback unless asked. And that will give you like a good gut check. And that way you ask that question when you've got 18 months of cash or 12 months of cash, not when you have 3 months of cash, right?
When you have 3 months of cash, it's a big problem.
You're in trouble. You're in
big trouble.
That's why I bring it up. Yeah.
I really advise founders to not dip below 12 months of capital. If you're doing well in a market like today, we're recording this in 2021, you might be watching it in 2025. In a hot market, savvy founders take advantage of a hot market.
Yep.
That's period, end of story. Obviously, boards tend to approve these plans when you get to another sort of level. And the plan also is about allocating money correctly. So when you say you want to grow 25% a month, you need to know the inputs there. Okay, how much are you going to spend on Facebook ads or Google ads? How much are you going to spend on a CMO? Do you even need a CMO? Are you going to use an outsourcer? How many developers are you going to need? Do you have the current feature set? What is the resourcing to hit these numbers, correct?
Everything you just mentioned, plus I'd add how many salespeople do I need?
Sure.
How many admin people do I need? And It's interesting because a lot of times we see companies get like maybe the marketing and advertising budget correct, but they don't staff up enough to support either those leads or being able to deliver on features. And so the company is a little bit out of whack. And so this is again why you do the plan, because you're visualizing everything.
Yeah.
And you get to take advantage of your board's feedback. Like they're all have horror stories of companies that messed up some aspect of it and can help you with that. But those are the key inputs. Those are the key people. And just doing the work will give you the answers ahead of time. And
I think understanding the reality of hiring. So you say you need 10 salespeople to hit these numbers. Okay, it's going to take you're going to be able to hire one every 3 weeks, let's say.
Yes.
You're also going to lose half of them, either by voluntary or involuntary, which really means you have to hire 20. Which really means you need to be hiring 2 every 3 weeks or 1 every 7-8 days. Who's going to hire one salesperson every 7-8 days? Like, that's a high turnover position. And then, okay, by the way, if you're going to be selling, 50 new clients a month, you're going to have 600. Do you have the customer success people and support people? And this is the rigor that comes into these kind of conversations, and why hope is not a plan. Plan is a plan. Make a plan. And then somebody on your team is hopefully going to say, we're going to have 600 customers. We have one person half-time managing 60. That means we need like 5 more people or something, 10 more people. Like, this is going to be disastrous if we don't get that online. The freeing thing of it is now you don't have to panic, because you can say, hey, every 3 salespeople, we should have 1 more customer support person online, so you can actually understand the ratio.
You have the ratio. And if I may, a little pro tip, when you've got that signed term sheet, I know it's hard to do and you're going through diligence, but if you're a founder and can kind of like pivot your brain a little bit to fire up recruiting, and because like you're talking about, it takes a while to get the recruiting engine going. And so we see companies miss their plan. Like, they close a round now, but they're missing their plan next summer. It's because they didn't have the recruiting engine hiring people fast. They waited, they closed the round, they did, then they took a week off or 2 weeks off. And, before you know it, you're behind your plan already. So all the things you're talking about, and then just kind of get it going a little faster than you might think.
Yeah. And the plan is everything. You build a plan, and then the plan is a living, breathing document. You're going to put your actuals in there. And then that's when, the accounting, the plan kind of come together in the board meeting. Okay, here's what our P&L says. Looking back, 2 months. Okay, here's August and September in. We don't have October yet. We're in November. Okay, but we got August, September's. Okay. Wait, our cash position is different. The P&L says this. The plan says that. We should have $1 million more. Or why do we have $500,000 extra? And it's like, we got a PPP loan for $250, and we didn't have to hire the PR firm. We just decided to internalize that. So we forgot to change that in the plan. And that's that little back and forth that can occur, where savvy people on the board are looking at, when you wonder what's everybody doing when they're looking at the numbers and squinting and trying to figure it out. They're trying to find some discrepancy or something that's not nominal. Just like when you have a rocket going off, if something's vibrating or you see some chip fall off the space shuttle, you're like, why did that tile fall off? Like, you're looking for things that are not normal. I think the word nominal in space launches means normal. So if it's not normal, okay, why is it normal? Why is it abnormal? It could be a good reason, could be a bad reason, could be a blind spot. Maybe you just made a mistake in your plan. Maybe your salespeople are cheaper. Maybe you hired more junior people instead of senior people, and you're getting 3 for 1. Who knows?
And being able to explain those deltas, and especially if they're positive or you're hitting your plan, I think is one of the single best ways to build confidence in your board. Circling back to that, would you fund me in the future question? If you've been hitting plan every month like clockwork, that makes that question, that answer, so much easier for them. Yeah, and ultimately, you need those people to be confident in you if you're a founder, because eventually, people like you are going to make the intro to the Series A investor. Like, if you are not pleased and don't want to put your credibility on the line, it's not going to help them that much.
We are all in this life in a credibility building exercise. Yep. You are for your services. I am for my dollars and investments. The founder is to receive those services and dollars. We're all in a bit of a credibility exercise, and doing the work. That's why this is signed by me. This is do the work. Yep. Doing this kind of work, as arduous and boring, and all due respect, it can be pretty freaking boring. I'm not saying that hanging out with accountants is boring, but it might not be the same as going to TED conference or something. But you got to get the stuff right, and if you get it right, my Lord, it lets you focus on other things, and you just feel more confident coming into work every day. The stress level in the company goes down when it's properly managed. Spend the time. Spend the effort, spend the money, do it right. Okay, Scott, great job. And I think we're going to talk about crypto in the next one and tokens and all that fun stuff. So stick around. And if you want to check out the corpus of all the basics we've done across a number of categories, just go to thisweekinstartups.com/basics. And if you want to get in touch with Scott, Kruze Consulting, Kruze consulting.com/twist, and you'll get all your needs met there as well. We'll see you next time.